Due to the COVID-19 pandemic, many Australian and US companies have been writing down their assets. This technique is called Big Bath and will be discussed further by myself, Bashneel, Adrian, Claire, and Bridgette. The main goal of every publicly owned company has always been to maximize shareholder value by generating as much profit as possible. Not only do the company owners want to have a profit at the end of every accounting period, but they also want companies' financial statements to look as good as they can. After all, the financial statements reflect qualitative information about the company's financial health and business activities, and are what potential investors and creditors look at when they make the decision of whether to lend the company money or become an investor. This is where many companies utilize the accounting tactic of Big Bath. Big Bath is a tool that is often undertaken in a bad earnings year and is utilized to manipulate the income statement to make poor results look even worse in order to artificially inflate future earning figures. Although unethical, firms can conduct this technique effectively within the boundaries of current accounting rules. Newly appointed CEOs often utilize Big Baths as a maneuver to dispose poorly performing projects, shifting blame of companies' poor performances on the previous CEO and thereby taking credit for the next year's improvement. The CEO can shift profits forward through prepaying expenses, taking write-offs, or by delaying the realization of revenues. By taking such measures, the Big Bath allows CEOs to receive a larger bonus, as Big Baths can cause a rise in future earnings. Banks are also seen engaging in Big Bath. Banks typically face rising delinquency and default rates on loans when the economy goes into recession and unemployment rates rise. These banks often write off the loans beforehand in anticipation of the losses and create a loan loss reserve. The loan loss reserves account is a contra asset account, which reduces the loans by the amount the bank managers expect to lose when some portions of loans are not repaid. A bank can effectively create a Big Bath and be liberal with the loan loss provision, as its earnings are hurt by tough economic times. When the economy recovers and loan repayments are paid on time in greater numbers, the bank can reverse the losses in loan loss reserves that were not realized and boost earnings in future quarters. Big Bath is a beneficial tool as management can benefit from higher compensation, and banks' share prices can recover from a fall during tough financial times. I will now pass it over to Adrian, who will discuss the advantages of flexible impairment.
Thanks, Bashneel. To understand why impairing assets on a flexible basis is beneficial, we first need to define impairment. Impairment is a permanent reduction of an asset's value. This is done to reflect a sudden or unexpected decrease in its recoverable value, which is, in other words, the asset's expected future economic benefits are less than the carrying amount recorded on a company's balance sheet. Assets are periodically tested for impairment. If there is a discrepancy between fair value and carrying amount, the asset value is credited by that amount and an impairment loss is recorded. Impairment exists in contrast to depreciation and amortization, which are scheduled and expected decreases in carrying amount. There are many potential reasons why an asset would need to be impaired, such as unexpected physical damage to PPE, reducing its potential to earn money, unexpected market conditions, for example, COVID-19 travel restrictions preventing airlines from using planes to generate sales, new technology or shifting consumer preferences which render assets obsolete, that is, not useful or able to be sold. For example, a software update which renders existing machines unusable. And lastly, we have new legislation which hinders the value of assets. This brings us to the first key advantage of allowing managers to charge impairment on assets on a flexible basis, which is enabling them to maintain true and fair valuations of their company's assets throughout unpredictable circumstances. Companies are sure to face unexpected damages and adverse external conditions throughout each reporting period that decrease their assets' values. Without a way to adjust these values, companies will have inflated asset valuations on their balance sheets, which can create false impressions for shareholders about their financial position. For example, a company that overpays to acquire another company may need to impair the goodwill recorded on acquisition if the acquiree doesn't deliver the expected economic benefits. The goodwill asset captures the overpayment and reflects a subjective judgment on what the acquiree is worth. The above situation occurred in 2015 when Microsoft impaired goodwill related to its acquisition of Nokia, whose assets were deemed to be overvalued in Microsoft's books. In unexpected situations like this, impairment is a crucial tool in maintaining accurate financial statements. Another advantage of flexible impairment charges is that they allow company stakeholders to assess the decision-making of company managers. Although asset valuations are subject to external and unpredictable factors, many impairments arise due to poor judgments, which resulted in assets being acquired despite their lower than expected potential for economic benefits. Large impairment losses, or a pattern of growing impairment, can both be endemic of ineffective management, resulting in purchasing non-useful assets, a failure to fully realize asset values, or that company assets are becoming obsolete, all of which can serve as a warning to potential investors. I'll now hand over to Bridgette to discuss the advantages of depreciating and amortizing assets according to a schedule.
Thanks, Adrian. To understand the advantages and why companies are required to depreciate or amortize their assets according to a prescribed schedule, it is important to define amortization and depreciation. Amortization is the accounting practice of spreading the cost of an intangible asset over its useful life. Intangible assets are not physical in nature, but they are nonetheless assets of value. Examples of intangible assets that are expensed through amortization include patents and trademarks. Additionally, depreciation refers to an allocation of cost of a tangible non-current asset's estimated useful life. As depreciation and amortization are systems of accounting that aim to distribute the asset over its estimated useful life in a systematic and rational manner, they should reflect the pattern in which the asset's economic benefits are consumed. Factors to consider when deciding depreciation and amortization rates includes whether the asset is subject to declining productivity, rapid obsolescence, deterioration at function of time of usage, the increase in the cost of maintenance, and that whenever events occur that trigger the need to assess an asset for recoverability. It may also be necessary to consider whether the method of depreciation and the asset's estimated useful life continue to be appropriate. Due to this, stakeholders will be able to reach a deeper understanding of the company's pattern of consumption with their financial reports on a prescribed schedule by evaluating both the method of depreciation and/or amortization along with the remaining useful lives of its long-lived assets as events and circumstances change. Another advantage of using a prescribed schedule is the absence of the risk of damaging a potential investor's confidence over the firm's ability to provide returns on investment. This risk is relevant to the practice of a big bath. For example, in the case that the profitability continues to decline in years following the big bath, the firm is continuing to report low or declining net profits, but also reduced assets due to the prior year's write-off, which may subsequently damage the confidence of investors. In this way, using a prescribed schedule of amortization or depreciation may be advantageous during long-term periods of uncertain financial performance. The tax benefit of depreciation exists due to the timing differences between when a tax expense is recognized on an accounting basis compared to when tax payable is owed as per relevant tax law. Depreciation generally will create a deferred tax liability. While there is still an existing obligation to pay tax in the future, the deferred tax liability can assist a company in managing overall cash flow, as the funds are reserved in a non-cash line item until the period that taxes are to be paid. It should be noted that the ability to claim such depreciation expense as a deduction to taxable income depends on relevant taxation law of the region the company reports to. Amortization is not always tax deductible. Deductibility varies between corporate income tax legislation between regions. Generally, legislation will define maximum amortization rates or minimum number of years in which deductions can be made. In Australia, the Income Tax Assessment Act defines such rules regarding tax amortization. Intangibles included which are allowed to be deducted include patents, registered designs, and licenses. The tax amortization rules of the US system are set out by sections within the Internal Revenue Code, whereby a 15-year recovery period for intangible assets such as goodwill recorded on acquisition or merger, trademarks, and licenses are established. The main tax advantages of amortization of applicable intangible non-current assets is the current year's tax deduction, even if you did not pay cash to acquire such assets. This can also be beneficial when anticipating a rise in corporate tax rates. Depending on the relevant tax legislation, if a company was amortizing using an accelerated method, switching to a straight-line method would allow the deductions to be saved for future years, thus improving future years' profits after tax. I'll now hand over to Claire, who will discuss our views on which approach is preferable from regulatory perspectives.
Thank you, Bridgette. So, in Australia, under AASB 138, assets without finite useful lives are subject to a yearly robustness test and impaired accordingly rather than amortized. An impairment model, if used correctly and fairly, allows assets that don't uniformly lose value to be recorded at fair value, providing more accurate financial information for investors and other stakeholders. These assets are generally intangible, such as research and development and goodwill, that are inherently more subjective in value. Additionally, the impairment model allows managers to account for unexpected circumstances, such as physical damage or adverse market conditions, that reduce assets' realizable value, unlike a rigid depreciation or amortization treatment. The latter treatment expenses assets based on expected useful life, and the expense basis is decided preemptively, assuming a particular pattern of operation is followed. However, the flexible impairment model, as discussed, does leave potential for manipulation of financial statements. By recognizing large impairment losses in 1 year, a company can claim an artificially large improvement in earnings the next year. This can create false impressions of company growth, managers' competence, and the overall future of a company, influencing share price. Managers have clear incentives to exploit flexible impairments, such as monetary bonuses tied to increases in earnings, which makes this a significant concern. While conducting a big bath is unethical, the legality of big bath will be dependent on the technique used, though there are various methods in which it is not illegal to conduct. In contrast, a depreciation or amortization treatment of assets will expense assets on a systematic and periodic basis, which leaves less room for overstating losses. Given the advantages and weaknesses of both approaches, a combination approach is most ideal to portray companies' financial position and performance in the most accurate way. Depreciation and amortization provide a fair and systematic way to account for predictable decreases in asset value, while asset impairment grants the necessary flexibility to account for unpredicted circumstances and assets which do not have consistent patterns of decline. With that, we conclude our discussion of Big Bath. We appreciate your time.